A lot of times people think that taxes and the relationship to their investment accounts is something that their CPA handles. In reality, it's something that you need to handle. You need to understand what we would call the tax personality of your account. There's essentially three environments in which your money can exist: taxable, tax-deferred, and tax-free. It's important to remember that not all of your income is taxed the same. A lot of people think, well, I just owe what I owe and there's really not a whole lot I can do about it. That's just simply not true.
Hello and welcome back to Retire Stronger. This is episode 41. I'm sitting here with my co-founder of Crown Advisors and co-host of the Retire Stronger podcast, Bill Kearney. Bill, say hello today to everyone.
Good morning, John. Good morning, everyone. Or good afternoon, depending on where you are and when you're listening.
Yes, well, welcome back. I know that we are going to continue today along the same theme of our previous episode, which is planning for a successful 2026, or in general, just planning for a successful new year. And I know that we ran a little long last time, so we pushed the additional topic we were planning to discuss in last week's episode, and we pushed it to this week. So that's tax planning. And basically, what we're wanting to talk about today is kind of, well, how do you manage your tax situation into the new year? And in other words, what is the best way to keep as much of your income that you earn, after that income shows up in your account, and now you owe taxes to the IRS, your state, all that. So that's what we're going to discuss today. And Bill, I don't know if you want to kind of do a quick rundown of some of the topics we're going to hit on today. I'm happy to do that, but I know you have a few items you wanted to discuss and kind of kick us off. So if you want, I can just kick it over to you and you can get going.
Yeah, it sounds good, John. I know that today we wanted to go through basically your tax bucket strategy, talk about strategic Roth conversions, RMD and tax, we call it the RMD and tax bond planning, and then some charitable strategies. So this is an audacious 20 minutes or so we have ahead of us here to get through this. So I'll just jump right in on the tax bucket strategy. And just as from like a 10,000 foot view, I really feel like a lot of times people think that taxes and the relationship to their investment accounts is something that their CPA handles or their tax preparer handles for them. And in reality, it's something that you need to handle. The person that owns the accounts, you need to understand what we would call the tax personality of your accounts, your investment accounts. And there's essentially three environments in which your money can exist, three buckets, if you will: taxable, tax-deferred, and tax-free. Okay, so just to give you a pretty simple definition of what these are, your taxable accounts would be things like brokerage accounts, savings, money markets. These typically are taxed at a capital gains rate, which can be more favorable to a lot of people. And it creates more of a flexibility with your money in being able to plan on how to take income through certain years. So that's basically the taxable bucket. These are things that can be taxed on an annual basis, year after year. All right. And it's important to remember that not all of your income is taxed the same, right? As we're talking about this, a lot of people think, well, I just owe what I owe and there's really not a whole lot I can do about it. That's just simply not true.
Correct.
Your accounts are taxed differently based on the environment that they exist in. So you've got taxable accounts. Your tax-deferred accounts are very popular with people, right? This would be your 401k, pre-tax 401k, your pre-tax IRA. This is money that you've been contributing to, usually through a employer-sponsored plan at work. You're putting money over there. You're deferring receiving that income in exchange for a tax credit each year or a tax deduction each year on those funds. And then ultimately what's going to happen in the future is you are making an agreement with the IRS that at certain ages, you're going to start withdrawing funds from those accounts. The key to remember is that the IRS determines which age you start withdrawing, and those ages have been changing, and what rate you're going to pay on those funds.
And all that is subject to change into the future too. I mean, even though we know and understand what those numbers are today, those are subject to change at any time.
Right. And every dollar withdrawn from these types of accounts is subject to ordinary income tax.
Correct.
So if you're being forced through a required minimum distribution to take money that you don't need, it might end up actually being taxed at a higher rate than you want it to be taxed at. Okay. So that's something to think about. This can create risk, tax risk in the future, a little bit of losses of tax control in the future. So ultimately, knowing what this is and what these types of accounts are and how they are looked at by the IRS is extremely important to know what ultimately a good idea of what your tax picture in the future is going to look like. So that's tax deferred accounts. And then tax free would be things like certain retirement accounts, right? There are certain accounts like Roth IRAs that are tax free. When you put money in these accounts, they grow tax deferred. And then when you take money out under the IRS's rules, the money that comes out plus the growth is tax free to you. And you might be thinking, well, why wouldn't I want everything in the tax free bucket? Right? If I don't have to pay any tax on this or the growth, why wouldn't I just throw everything over here? Well, there are specific individual tax reasons on an annual basis why you wouldn't put everything in this area. I think the key to remember in these environments is balance, right? You want to have the correct balance between taxable, tax deferred, and tax free in order to be able to have the best opportunity to optimize your tax situation. So did I leave anything out there, John, from a 10,000 foot view on the tax treatment of those buckets?
No, I mean, I think you hit on something that I was going to ask, right? I was going to pose the question, why would I not want everything to be in a Roth IRA or in some type of tax-free environment where I never have to worry about taxes? And I think you touched on that pretty good. Yeah, I mean, just to bring that home, folks, there's reasons why you don't want or don't need everything to be in a tax-free bucket like a Roth IRA. Everyone's situation is going to be different. Yours is going to be different from your neighbor, from your cousin, from your best friend, your coworker. Everyone's situation is different. So I would highly recommend seeking counsel, understanding your tax situation, and understanding what makes the most sense for you. And if you don't know what that is, just ask questions to find out. But it's a good point you bring up. And I think let's just kind of talk about the Roth a little further. I know we wanted to talk about, strategic Roth conversions, basically turning what we consider to be a significant tax problem or burden into basically a planning opportunity into the future. Bill, I think you and I tell this to our clients all the time, and we say, hey, the IRS gives you a window, where taxes can be or could be optional. And the problem is most people miss out on the opportunity to take advantage of that. What am I referring to here? Basically, trying to identify, low tax windows, basically. Let's assume for a moment, maybe you retired before your Social Security starts or before you decide to start taking it. This is going to be a window of time, an opportunity where your income is going to be lower than what it will be when you start receiving your Social Security benefit. And it could potentially keep you or help you stay in a slightly lower tax bracket, which would give you a better window for doing a Roth conversion. And again, I know we've talked about Roth conversions literally on every episode we've done, but there's a reason why. It can be a very good planning tool from a tax perspective. And, just so everyone's clear, if you do a Roth conversion, if you convert funds from a traditional IRA or a 401k plan where the money was put in a tax-deferred basis, when you convert that to a Roth, you're going to owe income taxes on every dollar you convert in the year that you do that. So just be aware that that's what I'm referring to when I say there could be an advantageous window to make that conversion happen if you are at a lower income level prior to taking your Social Security benefit. Also, if you retire prior to required minimum distributions beginning for you, and right now the current age where RMDs start is age 73. In the future, it's going to go to age 75. They may change that. Who knows how it will change? We don't know. We don't have a crystal ball. But if you are retired and your required distributions have not yet begun, then that is another window where you could potentially help yourself by doing Roth conversions and possibly be in a lower tax bracket as well. All right. And then let's assume you have a year where your income is unusually low. Maybe you have some gap years between receiving, like I said, Social Security, or you have a business exit, or you take a sabbatical from work. These would be potentially good opportunities to look at where you could do some Roth conversions and not have your situation be detrimental from a tax burden perspective. Bill, I don't know if I've left anything out there. I'm trying to rack my brain here to see if there's anything else I should add in this topic, but anything you want to kind of hit on?
So yeah, I think that there's so much here, and I know. Can we put the car over on the side of the road and put the blinkers on for just a minute? Because I got to. So there's something I think a lot of people don't think about when they start contributing to their employer-sponsored plan at work.
Yeah.
In my professional opinion, I believe what's happening is you are entering into a multi-generational relationship with the IRS.
Oh, 100%.
And the reason for that, and we're seeing this every day with people that we work with, the reason that we say that is ultimately the IRS, through the Secure Act and now the Secure Act 2.0, they continue to fiddle with these ages at which you have to start taking money out on a required basis from your pre-tax accounts. I have a theory behind that. The common, if you Google it, the common theory is, well, the IRS is helping people grow their money or allowing them to grow their money longer before being required to take it out. I don't think that's what's going on here. I think what's actually happening is, if you go back to the original Secure Act, what it did is it changed the requirements on people who inherit an IRA, for example, from your parents. Previous to that act, you could stretch out the required distribution you had to take on an inherited IRA over the rest of your life. There was a calculation that was made on how much you had to take out. When the Secure Act came in, it changed that relationship and squeezed everything down into 10 years, meaning you had 10 years once you received that inherited IRA for anyone who passed away after 2020, I believe it was.
Yep. I'm sorry, I didn't interrupt you. I was going to say, and that's not exactly just cut and dry either. I mean, if the person you inherited that IRA from, if they had already started receiving distributions from because they had already hit required minimum distribution age, then I believe the way the law is written is you have to, now please folks clarify this with your CPA, but I believe you are required to take some level of a distribution every year, but then also have the account liquidated at the end of 10 years. But Bill, correct me if I'm wrong, if the person you inherited the IRA from had not yet achieved the age for their required minimum distribution, then you could wait all the way to the 10th year before you take anything out, but it just still has to be liquidated at the end of the 10th year.
Yeah, there's all these little murky rules that
Correct.
are in there. But my theory behind this is what's happening is that the people that are inheriting the IRA and then taking funds out over a compressed 10-year period are then having to take money out. And because they are typically in their high wage earning years, it forces the money they're taking out into a higher tax bracket.
Correct.
A higher marginal rate than what the original owner of the account would be taking the money out. That rate would be lower typically for that person in retirement. Forgive me for being skeptical on the IRS's benevolence here, but I think ultimately they are looking at this and playing the long game and saying, well, if we actually wait until these accounts are passed down to the next generation, we'll actually get a higher tax amount out of the accounts than we would if we just forced the RMDs on the person who owned the account originally. I truly believe that's what's happening here. I've not heard anyone else talk about that, but that's what we see on an annual basis now, because we have a lot of clients who are having to plan for this 10-year window, and they're being squeezed all the way up into the 37% bracket at the top rate there based on their total income for that next 10-year window. It's incredible.
It is. And which brings up a good point. I think a lot of clients that we deal with, they're like, hey, I've got a $500,000 or $1 million IRA or a 401k plan. I don't want to convert all that to a Roth. Well, that's a great point. You don't have to. This isn't an all or nothing scenario. You can do partial conversions. And, if you're in a situation where you've inherited an IRA and you're being required to take funds out over a 10-year period, that definitely changes things, because now you've got to deal with that hit to your bottom line income that you're reporting. So that may have an impact on how much you can, or maybe you cannot at all do some Roth conversions right now because of that inherited funds that you've received. But folks, doing a Roth conversion is not an all or nothing, situation. You can do partial conversions, and you can use those partial conversions to fill up lower tax brackets intentionally, right? So if you're in a lower bracket and you have room to claim additional income before bumping yourself up to a higher bracket, that might be a good opportunity for you. And what we basically say is just remember to be very careful. Look at your situation with intentionality, because you want to avoid pushing yourself into those higher brackets. And this also, doing partial conversions allows you to maintain flexibility year over year. You're not required to do this every year. You can do it this year, you can skip the year after, and you can do it again the following year. It doesn't really matter how you do it. It's just what matters is, the planning that goes into making sure that what you're doing here doesn't have a detrimental, a serious detrimental impact to your overall situation. So that's from a tax perspective. So that's kind of what we're trying to get at here. So, also, if you're in retirement years, or if you're in the years of your life where you're now taking Medicare and you're having to pay for Medicare, you want to be careful too because of IRMAA, right? Medicare premiums are income-based. Roth conversions increase your modified adjusted gross income. One large conversion can trigger multi-year premium penalties. So you need to think about that as well. So these are all things that we think about, that we talk about. Basically, if you're not aware of what IRMAA is, it's basically it's a stealthy tax that's kind of that kind of hits you out of nowhere if you're not prepared for it. So again, good Roth planning balances tax savings versus healthcare costs. This is why Roth conversions must be coordinated, not guessed. It's not just a let's just see what happens kind of situation. We don't want to fly by the seat of our pants here. So, Bill, I think we beat that to death. Let's move on to kind of what we wanted to talk about next.
Yeah, the RMD and tax bond planning, and I think everything you just said plays into it's not only about what you're going to have in Roth accounts later on, it's tax-free that you can withdraw from, but it can have a very positive impact on the amount that you are going to be required to take from your IRA account, your pre-tax account, later in life. Now, in 2033, based on the rules right now, the required minimum distribution age, the age at which you have to start taking money out of your pre-tax accounts, is going to increase to age 75. Again, I think playing into the theory I was explaining earlier. So for right now, it's age 73. If you're 73, if you've got money in these accounts, there's a calculation that is made based on the end of last year's balance as to how much you have to take out of those accounts this year. If you do some partial Roth conversions, that will impact or can impact later on what your RMDs look like. So it gives you a bit more control in the future over how much you're going to be required to take out. And this is important because you might not want to take any money out of these accounts, or might not need to take any money out of these accounts. And doing so is going to hurt you in the sense that it may push you into a higher tax bracket, right? Or tax rates just simply rise at the time you're going to start taking money out of them. So we look at this and say that RMDs, which is short for required minimum distribution, you'll hear us use that acronym a lot there, but RMDs aren't the problem for you, but they're a symptom of failed planning, right? Because if you're being forced at age 73 to take out $68,000 from an IRA that you don't want to take, that means that some planning windows were missed probably about 10 years earlier. And that's extremely important because all of these things play together in optimizing your tax situation, not only currently, but for the future.
Yeah. I mean, Bill, you hit on it a little bit ago about how, where we both kind of talked through it a little bit, you mostly, that there's a reason why we don't want or don't need everything to be in a tax-free bucket like a Roth IRA. If you plan accordingly and we take advantage of these windows of time where it's more advantageous to do a Roth conversion, for example, and you remove as much of your tax-deferred funds from those buckets as you can and get them into a Roth, but leave an appropriate amount in those tax-deferred buckets, there's a great potential where you could still be, when you're forced to withdraw funds from those accounts, there is a high potential. And again, nothing's guaranteed, and we're not saying that's the case, but there's a high potential that you could be able to put yourself in a position where you're withdrawing those funds because you're required to do so. They are taxable, but because you have planned appropriately, you now have that standard, deduction that you are working with in your favor that will go against that distribution to allow you to basically receive that tax-free potentially as well. So I think I'm just trying to drive home kind of why you were talking through that earlier and why we brought that up. But I think that's where you were going with that.
Exactly. And we're just about out of time here. So I'm going to very quickly just hit on the last topic, which was charitable and legacy strategies. I'll put it to you this way. I'm going to give the IRS a little credit here since I was ripping on them a little bit earlier. But you have to remember that the IRS does reward your generosity if you give the right assets. And so there are certain ways that you can give money from your qualified plan and get a benefit for that. Typically, this happens when you hit RMD age. They're called qualified charitable distributions. If you're not familiar with what this is and you think it might be something that you need to look into as part of your overall strategy, certainly ask your financial planner. Ask us. We're happy to help you with understanding what this is, because this is oftentimes a forgotten or leftover piece of a financial plan from a tax planning standpoint or tax optimization standpoint that is left out. And it's important because this can ultimately reduce your adjusted gross income. It can ultimately help you control your Medicare premiums. It might keep your Social Security taxes lower. So there are all sorts of benefits on being generous that you can receive if you plan for it accordingly. So I'm just going to leave that kind of at a 5,000 foot level out there. If you're not familiar with how this works, certainly reach out and get some help, because it might be a very important part of your overall strategy. And certainly we think it is in what we do. So I'll leave it there, John, and let you kind of wrap this up in a bow for us.
Yeah, all good points there. And I appreciate you coming on and doing this episode with me today. Folks, if you have questions, if you have concerns, or if you just don't know where to start, please feel free to reach out to us. You can find us at our website at crownadvisorgroup.com. You can also hit a button on there to schedule some time to speak with us, or you can just give us a call. 704-469-0200 is our phone number. Or you can shoot us an email at info@crownadvisorgroup.com. We appreciate you listening to us or watching us today, whichever medium you choose to check us out. But feel free to hit that like button, that subscribe button on YouTube or Amazon or Apple or Spotify podcasts. We're pretty much on every medium you can find us on. Share us, like us. We appreciate it. We look forward to seeing you next time, folks. Have a great day. Bye-bye.